Why 2022 such a bad year for stock market? All stock sell-offs are painful, but some are more painful than others. A team of analysts at Bespoke Investment Group has crunched the numbers and determined that 2022 has so far the worst year for markets in at least 5 decades, based on analysis of stock and bond market returns heading into the final week of August. Why 2022 has been such a difficult year for retail investors? One of the reasons why 2022 has been such a difficult year for retail investors is that both bonds and stocks sold off in unison, leaving retirees with a traditional 60-40 portfolio, with now here to hide. At least when stocks plunged in 2008 and in 2020, investors have the option to seeking safety in the bond market. What Bespoke team wrote: no matter which way you cut it, 2022 has been the worst year of the past half-century for stocks and bonds combined, the Bespoke team wrote in the research note. The stock market is likely headed for its worst year since the great financial crisis in 2008, with major indices such as the S&P 500 and Nasdaq Composite down about 19% and 32% respectively in 2022. But investment professionals surveyed in bank rates fourth quarter market maven surveys see some relief coming investor way in 2023. The group of analysts expect the S&P 500 to increase 8% over the next 12 months, the 9th straight quarter the group has predicted gains. Stocks have had a difficult year, with both the S&P 500 and Nasdaq in bear market territory, while the Dow Jones Industry Average is down about 9% in 2022. Investors have pulled back on risk as the Fed raises interest rates to combat high inflation and concerns grow that the economy is headed for the recession. Inflation has softened somewhat recently, but the Fed hiked interest rates by half of a percentage point at its latest meeting in December. Inflation, rising rates hit the S&P 500 in 2022. The market performed strongly through 2022 on the back of low interest rates, but high inflation and rising rates have dashed investors' optimism this year. Interest rates do play a very important role, and they have caused many recessions in the past, one that central bank is too aggressive with, trying to hike its rates, and giving that inflation's really high right now. The central bank has kind of expressed that it's interested in being aggressive with those interest rate hikes. But that aside, there are other factors to consider with why. Some people are concerned that a recession is around the corner. On the one hand, we are still dealing with COVID-19 and the very many kind of restrictions and supply chains kinks that comes with that, with China being kind of top of mind in that area. There is also, of course, Russia's invasion of Ukraine, which has caused a cutoff of exports from both of those countries from very important commodities around the things like wheat, precious metals, oil obviously being an important one, in natural gas for Europe, which has led to that supply side inflation for a lot of European countries, as well as even here in North America for certain things. And because of a high inflation that's not only tied to the supply chain kinks, but also to that incredible, unprecedented monetary stimulus we had during with the inflation, governments are starting to try and reel back their spending also, because their debt is now becoming more expensive, and with those supports being taken away, that's obviously gonna play an important role for the economy moving forward. And in addition to rising interest rates, which will be very important variable for those economies, there are another very important monetary policy that will be coming into effect as we come out of pandemic and the resulting lockdowns, and that is a quantitative tightening. We might have seen that a Federal Reserve has kind of outlined plans to start its unwinding of its balance sheet. All you need to know for the purpose of this video is that during the pandemic we had quantitative easing, where the central bank went out and bought assets from the market, namely treasury bonds, mortgage-backed securities and corporate bonds. So they were directly supporting these markets, making capital easier to access for those different parties. And now as we enter quantitative tightening, it's essentially the reversing of that. So what that means is that the Federal Reserve will go from being one of the biggest buyer in the market, one of the biggest seller as they unwind their balance sheet, and with just under 9 trillion off. Trillion with the T as in the size of countries that's going to be selling pressure, and all these variables combined do increase the portability of the recession, all else held constant. So that's at a high level why there has been this sort of broad-based sell-off in multiple markets. People are concerned that we are having a global recession, and the US recently reported its first kind of contractionary quarter, beginning of 2022, which is one half of the way toward the recession, and that's kind of a big concern right now. During the pandemic, we had this sort of flash recession that was quickly dealt with. Unprecedented stimulus from governments and central banks, and now many people are worrying that we're finally going to pay for the recession. We didn't fully experience back then, as we're still dealing with lockdowns and economies. Get over what has been one of the biggest impacts, global supply chains, that we've seen in the modern age. Which is why now we're starting to see more articles and headlines talking about the coming global recession. The economy and the stock market are two separate things, and they measure different things. And what that means is that a stock crash is not itself indicative of recession and vice versa. They certainly are related in that a recession can cause a stock crash. It doesn't impact profitability as consumers pull back spending. An investor who needs capital might have to sell their positions, and that can supply downwards pressure. So the two certainly aren't mutually exclusive, but just because we'd had this downturn in the stock market in many markets over the past few days, for example, it doesn't itself mean that we're about to experience recession. You might have noticed that the companies that fell the most over this past, earning cycle if you will, are the ones that had very stretched valuations and were growthier firms. Over the past earnings cycle, many of these companies didn't meet higher investor expectations because during the pandemic, when we had all this ridiculous stimulus that was, supporting these results, these companies received remarkable returns and growth rates. And now that things are normalizing, we're seeing their valuation normalize. But that itself doesn't mean that we're necessarily experiencing a recession. It just means that very expensive stocks are being rationalized as people realize that these very high growth rates aren't sustainable into perpetuity. That's going to impact the valuation of these stocks. That if you use kind of any metric has been very stretched over the past few years. And when you zoom out to the broader market, if you look at the S&P 500, for example, it's actually still up from its pre-pandemic level. In fact, it's achieved roughly an annual rate that's in line with its long-term average of around 10%. Some people are very stressed out, right? Is when you are an active investor. And perhaps let's say you started investing through 2022 and 2021, and now your portfolio is down a big amount because of this recent correction. Here's the thing, I won't say that you shouldn't do anything with your portfolio. I do think that the time to adjust your strategy is before a market downturn occurs. You should always have a pulse on, and your tolerance and things like that. Buying the dip is great, if you have faith in the companies you hold. Investment professionals surveyed in Bankrate's fourth quarter. Market Maven survey sees some relief. Coming investors weigh in 2023. The group of analysts expect the S&P 500 to increase 8% over the next 12 months. The 9th straight quarter, the group has predicted gains. Survey respondents predict the S&P 500 will rise to 4,243 over the next year, up from 3,934 when the survey period ended on December 9, 2022. The experts strongly prefer US stocks over international markets and value stocks over growth stocks. For most investors, slow and steady win the race, Hamrick added. While there's intense interest in the daily movements of the stock market and individual issues, most mere mortals aren't capable of successful timing the market. That's why staying invested is key for long-term investors. This is stressful for a lot of people, especially people who only started investing over the past 2 years. I'm hoping this video helps a little bit. Hope you enjoyed the video. If you did, please leave a like and subscribe. I really appreciate it. Helps out the channel. But that's all do us for today. Thanks for watching. Make sure you follow Dollar Talk. For more videos, stay tuned. See you in the next video.